Good morning, good afternoon, and good evening, whatever time it is you're watching, and welcome back once again to the HarbourTrust Financial Podcast. My name is Shane, and I'm joined as always by my co-host Phil. And today we are going to be revealing a couple of secrets. We're going to be talking about something for future and current homeowners that banks do not want you to know. Apologies if you're representing a bank, and apologies if you're watching this from a bank, but we're about to break some stuff down that is very important, I think, Phil, about home ownership, specifically tied to mortgages, specifically tied to insurance in mortgages. So we're going to unpack mortgage insurance today, Phil, right?
Yep, that's correct. So we're going to be talking about who needs mortgage insurance, why you need mortgage insurance,
What is mortgage insurance?
what is mortgage insurance, and some of the things that you need to know regarding mortgage insurance and the difference between having a mortgage insurance with somebody like us as financial security advisors or versus with a bank.
The bank. And today I got my tie on, Phil. Today is a very serious episode. It's serious business, and I got my tie on today. So I'm very excited about this one, and looking forward to hearing these talking points. And we've prepared a couple of factoids here that we're going to expand on. And I think we can jump right into the meat and potatoes. Phil, why don't you kick us off?
Yeah. So the introduction of a mortgage insurance. So why do we need mortgage insurance? And some people do subscribe to some people don't even know what mortgage insurance is.
Most people that I meet have it and don't know they're paying for it, which is, I think, should be alarming from the get-go. I want to say this early on in the podcast so you can, truck through this whole episode. It's very important. But the odds are that if you own a home, there's some pretty high odds that you're paying for this, and you might not even know about it.
Mm-hmm.
Yeah.
So when is mortgage insurance offered? So whenever somebody gets a mortgage,
Mm-hmm.
when is that generally offered? Whenever somebody's putting less than 20% down
On the house.
on their home, then it's offered. And the reason why it's offered is because it's going to be a big liability for the banks in order to lend the money, so they need to protect themselves that way.
Mm-hmm.
But if you put more than 20% down on your home, generally it's not offered
Right.
for the client.
Right. But does that mean you don't need it?
No, we
Absolutely
strongly
not.
recommend it.
Exactly.
It's just not offered.
It's just not offered, right? And I just want to make sure that is very clear. Just because you put 20% down on your mortgage okay, cool, I'm good. It doesn't mean that you're good. It doesn't mean that you shouldn't be looking into this. But yeah, it's a good point there, Phil. Sometimes it's offered, sometimes it's not. It depends on how much you put down into the mortgage.
That's right. And who needs mortgage insurance? I think personally everybody needs mortgage insurance.
If you have a mortgage, you need it.
Yeah, they do. Because what's going to happen, Shane, if somebody has a mortgage and don't have mortgage insurance?
Well, it's very simple. Mortgages don't disappear. I want to say that again. Mortgages don't disappear. If you pass away and you have a mortgage, somebody's got to pay it back, right? And if you're not alive, well, right, if you're in a disability, if you're sick and you can't work, you can't produce income, like, mortgages don't disappear. They don't just go out in thin air. They don't follow you in the grave. For those who say, bury me, throw me down the hill, throw me in the ocean, whatever, I don't want a funeral, yada, yada. Sure, the mortgage ain't going to follow you, though. It's staying right there, and somebody's got to pay it back. And unfortunately, the person who's going to have to pay it back is probably the person you least want to have to pay that back, especially if it's a shared mortgage with your spouse, if you have a family living in it, if you have kids living there. That's going to be the responsibility entirely on that one person, on that one income that remains in the household, and that's not a good thing. So,
and if you leave a large mortgage behind on a one income that somebody can't afford to do that, most of the time will be forced to sell the house as a less value, so you lose that equity you've built over the years. And mortgage insurance is not expensive.
It's not.
It's not really expensive
No.
because mortgage insurance, also known as, it's a life insurance. It's a term life insurance,
Right.
because it's temporary, based on the time frame of the mortgage.
Correct.
So if you have a 20-year mortgage,
Right.
then it's going to be tied into a term
20 life policy.
That's right. Or if it's a 30-year or 25 years, same.
We got
thing
30
as well.
years now in Canada coming in December, but and so on and so on. But so it's typically very inexpensive due to it being a term life insurance policy. Term life is known to be, we have our episode on 5 types of life insurance where we unpack that a little more in depth, but term life is known to be the least expensive form of life insurance.
So let's talk about the misconceptions of life insurance, because some people don't know the difference. Well, I got my mortgage through the lending company,
Right.
and then they offered me the mortgage insurance, and
Right.
I opt into it.
Right.
And generally, that's what it happened to me as
Okay.
well 6 years ago, whenever I got my mortgage. So I opt in to the mortgage insurance without knowing the difference. By
Really?
going
Okay.
privately or going with the bank.
So you've been through this yourself,
Yep.
personally.
Yep.
Okay.
And it was a very quick approval, but the more I was learning into the mortgage insurance, I was like, wait a minute. I don't think it's a really good idea for me to go through the lending company. It's better off for me to go through somebody like a financial advisor, somebody like us. Okay.
Would that be because we're actually licensed? Oops. Oops.
Well, generally speaking, financial advisors at banks are not licensed financial advisors. Unfortunately, they're offering the product that they have.
Right.
So that's one of the big misconceptions. The public or the person that gets their mortgage, we don't necessarily look up if that person is licensed or not.
Do we ever ask the question, like who the hell is going to ask the question to the banker, or like the person giving you your mortgage at the bank, like, are you licensed to give me insurance? Like, nobody's going to ask that, but
And
you should.
the reason behind that is because that trust that the public has with the banks.
There's this pre-existing conception that the bank is this tell-all, say-all, tell-all, and that's the final destination of everything finances, which is, in my opinion, one of the most misleading facts in the financial world for the average consumer.
I think it boils down to knowledge too. People just don't know.
Just general education
and
awareness.
And the purpose of us kind of educating you is why we're doing this episode as well. So let's talk about the first misconception, ownership of the policy. Okay. The bank or the lending mortgage insurance. So the policy is owned by the lending or the bank, meaning they are the beneficiary. The insurance is directly tied to the mortgage, and the coverage decreases as the mortgage is paid off.
So what that means is that if I have mortgage insurance through the bank or through the lending company, the individual or the organization that gave me my mortgage, they're the one that gets paid when I die?
That's correct.
I don't get paid. My family doesn't get paid. Well, of course, I don't get paid. I pass away, but my family doesn't get paid. Nobody in my...
The bank chooses themselves as the beneficiary.
And I'm paying for it.
And you're paying for it.
That's fantastic.
Okay.
Okay.
So, and we'll talk about more of a scenario later, but the bank will put themselves as the beneficiary. Something happens to the owner of the policy. Bank gets the money. The bank pays off the mortgage. There's no money goes to the beneficiary of the family.
What's on the other side of the fence?
So financial security advisor insurance through us. So the policy is owned by the borrower, which is you, and you have the control over the policy, and you choose the beneficiary, who could be your family or your estate. The payout remains constant through the policy term, regardless of your mortgage balance.
That is one of the biggest keys, I think, to kick off this conversation, Phil, because I'll put it in simple terms. I have let's say a $100,000 mortgage, and I start paying for my mortgage on day one. I just bought my house and I have mortgage insurance through the lender. Here's what's happening. Let's say I'm going to choose $50 per month as the amount that the lender is charging me. By the way, you probably wouldn't know exactly how much you're paying because it comes out on your mortgage payment. So if my mortgage payment is $300 biweekly, well, it's going to be $325 biweekly because $50 a month is my premium for insurance, and it's just coming off my payment, so I'm not seeing it. So that's the first thing to pay attention to. So let's say $50 per month on a $100,000 coverage on the mortgage. I'm going to start paying off my mortgage. 1 year, 2 years, 5 years, let's say 10 years go by, and I've paid off half of my mortgage. I'm at $50,000 now left to pay. That means I'm still paying $50 a month for this coverage, but if I die, the bank will get $50,000, not $100,000. The value of my coverage is decreasing as I make my payments.
Correct.
Versus on the contrary, if you come to a private institution like ourselves, you are getting $100,000 at probably less than $50. It's typically actually cheaper if you go through a private institution. It's the same price or cheaper. It's very, very rarely have we seen it be more expensive. So for the same price or cheaper, I'm maintaining $100,000 as I'm paying off my mortgage. So let's say in 10 years, there's $50,000 left and I pass away. Instead of the bank receiving $50,000 and paying themselves on the premium that I've been paying, my family will receive $100,000. They will pay the bank $50,000 to clear the house. Thank you very much. See you next year. And then after that, they keep their $50,000 and they do whatever they want with that money. And I was actually paying the same or less than I was paying.
Yeah, and the family will get the full
And the family
amount.
gets the full amount
When you subscribe. I'll talk about pricing as well in a little bit.
Yeah.
But 9 times out of 10, it's going to be cheaper to go with somebody like us because we are an insurance company.
That's what we do.
But there's also on the other side, I'll be explaining a scenario too that sometimes it's not always cheaper with us, depending with age, smoker, non-smoker, and all that. So we'll get to that in a minute. But the second misconception is also the portability. Okay, so the bank or the lender insurance, the coverage is tied to the mortgage. So if you switch lenders or refinance your mortgage, you often need to apply for a new policy, which could mean higher premium as your age or your health changes. So give an example. You're about to renew your mortgage.
Okay.
You have it for 5 years. You're about to renew it, and bank XYZ that you're dealing with, but you know that bank ABC has a lower rate, lower interest rate.
So you have a better interest rate on your mortgage.
Yep.
It's kind of a good idea for you to switch.
So you switch or you go through a mortgage broker and they have a good deal somewhere else and they say you should go there. Perfect. And then you go and you switch a lending company.
Okay.
What that means with a bank is your mortgage insurance gets terminated because it's tied into your mortgage. If you move your mortgage, refinance, whatever you do with your mortgage, that insurance gets terminated.
Regardless, I was paying for this and that's it. You're done.
And then when you start with another company or you remortgage or refinance, you will subscribe to the new age, which you're going to be 5 years older, 3 years older, whichever it is. Your health may change. You may not even qualify for it. So then that changes on that side.
So you're just taking on a bunch of risks for absolutely no reason.
Yeah. And with us as a financial security advisor, the policy is independent of the mortgage, meaning it stays with you regardless of where your mortgage is held. If you switch lenders or pay off your mortgage, you still maintain your insurance coverage. So it doesn't matter. You can bounce around for the best rate, you port your mortgage somewhere else, and that insurance will follow because for the same thing, the mortgage insurance now is insured you as the borrower versus insuring the mortgage.
Okay.
So wherever you go, that policy will follow you and will never change. The premium will stay the same for that 25 years, for that 20 years, for that 30 years.
So if I'm 25 years old and I have my mortgage for 5 years locked in, and it renews in 5 years, so at 30 years old, at 25 years old, I started my mortgage insurance policy. At 30 years old, if I want to switch institutions because I would like to have a better rate on my mortgage, you're telling me that I'm going to have to start paying a new premium because I'm now 30 years old.
Yep, at a higher rate.
At a higher rate.
Yep.
And
for the exact same thing.
For the exact same thing, the bank or the institution is going to keep that money. It's going to decrease over time. So right there, it sounds to me like a huge negative. Definitely not something that I would include in my portfolio, but however, we'll keep going on more points.
Yeah, another point here is the coverage amount. So through a bank or the lending insurance, the coverage decreases as the mortgage balance decreases. If something happens to you, the payout will only be enough to cover the remaining mortgage balance.
So again, kind of talking about that point that we're saying, as you're paying off your mortgage, your premium that you're paying with the lender or the bank is fixed and the amount that you're getting is decreasing.
That's right.
If you go the other route through a private institution with a licensed financial security advisor, you are paying a fixed premium. Same thing. It's probably less. And your coverage amount is leveled.
Yep.
It's fixed.
That's right.
It is not decreasing. It stays the same no matter what.
Exact. So the coverage amount is fixed and does not decrease over time. The death benefits will be the same throughout the life of the policy, which means your beneficiary received the full amount regardless of how much you owe on the mortgage. So what that means is the beneficiary now controls the payout. So there's $200,000 left on the mortgage when you first subscribe at $500,000. They'll take that $500,000 being given to the beneficiary, pay off the $200,000, $300,000 is left for the family.
And they get to determine what happens with that $300,000.
Exactly. And then you can disperse it to pay off other debt,
Absolutely.
funeral costs, whatever it is, but you get the full amount of when you subscribe.
That is really great.
The fourth point is flexibility. So through a bank or lending insurance is the limited flexibility. The insurance is specifically tied to your mortgage debt, and the funds are paid directly to the lender to pay off the mortgage. And through a financial security advisor offers more flexibility. The death benefits goes to your chosen beneficiary who can decide how to use the funds, whether the mortgage repayment, other debt, living expenses, or anything else.
So again, talking about that point that we just mentioned, the beneficiary, if you determine it, gets full control on what happens with that payout at death, and it can go, there's no rules or guidelines towards where that money goes. It's entirely up to the discretion of the family to dictate how that money is used, because they're the ones paying for it. I think they should be determining how that money is used versus paying for something that somebody else is going to keep in pocket on your dime. I think is absolutely absurd. But
I'm going to add another interesting point for flexibility.
Okay.
With us, when somebody finishes a mortgage insurance or a term life insurance, they have the option to either the policy to terminate and let it go, or they can convert it into a whole life policy.
So you can transform that policy
Correct.
to stay with you
Yes.
even after your mortgage is paid off and you
Correct.
don't need it anymore. You've aged quite a bit. Maybe you've had significant health issues that have decreased your odds at getting insured for other reasons, maybe funeral costs or final expenses or clearing debts or taxes at death, or the list goes on and on. So you're telling me that this mortgage insurance that we got because we bought a house 40 years ago, 30 years ago, 20 years ago, we can now change to stick with us permanently?
Yeah. And with the bank, unfortunately, when your mortgage is done, because it's tied into your mortgage, the policy terminates, you can't transform that. So there's a lot of flexibility by going with somebody like us as financial advisors versus going through tying in your mortgage insurance through the bank. And the good news, when you transform that policy, I'll give you another example. What if someone over their time, they've developed health issues,
Right.
and now they can't get life insurance? So let's say you subscribe for that mortgage insurance at $500,000 for your mortgage, an example.
Okay.
So
For
now,
25 years.
For 25 years.
Let's say.
And then you're arriving at the end of your term of 25 years. You have the capability to transforming that to a whole life policy, up to a maximum of $500,000 without proof of insurability.
So
However,
no medical questions,
no
nothing.
medical questions.
Okay.
It needs to be $500,000 or lower. However, if someone wants to subscribe for, they transform it to another term life or a whole life policy, and they want to go over that $500,000, there's going to be some medical questions that we'll need to ask because it's over that predetermined amount that we've already
We're now
underwritten.
increasing the payout, right?
Exactly.
Okay. That makes sense.
Which lead to my fifth point is underwriting. Okay, this is huge for everybody.
I remember finding out about this point, and I know what fact you're gonna belt out here. Brace yourselves at home. Listen very carefully to this. This is the biggest point on this episode, I think, that we're gonna mention. And when I learned this, my jaw dropped. I couldn't believe that this is how mortgage insurance through lending institutions and banks actually works. To me, it's absolutely absurd, but I'll let you go ahead.
So with the underwriting through a bank or a lender insurance, the underwriting often happens after a claim is made. So post-claim underwriting. This means the bank may investigate your health status at the time of death, which can sometimes lead to denied claims if any discrepancy are found. So people need to know that that's why it can go so quick to get approved with a bank. They only ask a few questions. And sometimes if there's a claim that needs to be made and the bank don't pay, that's where a lot of people say insurance are crooks, they never paid.
It's a scam, they take money and they don't pay back.
But it's not that they don't want to pay. It's because in their contract, and it's not, the financial advisor's fault at the bank. They're just pushing the product, telling the people like
they're doing what their boss is telling them to do, right?
Basically, and they don't put the rules in place.
They don't make the rules, right?
So they're just applying the policy tied into
and
the
then
mortgage.
Most times they're not even licensed in this, so they don't even know the due diligence that needs to be done to have these facts understood by the client.
And so when there's a denial, what happens generally is the bank will reimburse all the premium paid and say, sorry, we can't pay. Here's all the money back you've been paying in for the last 15 years. Okay. So it's very important to know that people need to understand that you are taking a risk that they may not pay you.
They are going to determine whether or not they will reimburse your mortgage at the time of your death.
Mm-hmm. So for young people, like young 20s, mid 20s, they may not really care, be like, I don't care. But the older you get, you're like, wait a second, I've been paying this for how long? That $50 bi-weekly or that $50 a month
right.
through my mortgage. And then you're just going to reimburse me the money and you're not going to pay. But yet I have other debt. So people need to put themselves into a perspective that what if I leave my mortgage to my spouse or to my kids and there's also other debt involved, and then all this can't be paid.
Right.
Now they're forced to sell the house at a lower price, or the bank takes over the house because there's a foreclosure. I know these sound scary, but these are real life situation that does happen, unfortunately, on a weekly basis across Canada.
You betcha.
Okay. But so what is the alternative of that with the underwriting? Like, how do we underwrite our stuff to make sure that we pay? So the underwriting is typically happens upfront, meaning any health assessments and eligibility are determined when you apply for the insurance. Once you're approved, your coverage is more secure and there's less risk of a claim being denied later. So there's only two ways that an insurance company through us when we do the underwriting before. So there's going to be a little bit more questions upfront, but you're going to be secured and we pay the claim. There's no way that we can't pay the claim. If there's two ways that we won't claim. Fraud, if you lied on your application and we found out later that you lied and you were technically not eligible to get that policy, we won't pay. And suicide. But suicide gets interesting because over the last 5 years, it's been a big topic in the insurance industry with suicide. So our policies, how it works is the first 2 years, we don't cover suicide.
After 2 years,
we do cover suicide. Okay, and that's important because it's been at first it was interesting 5 years ago, a lot more. Now it's becoming, I don't want to say more common, but we put some rules in place and regulations that after 2 years we do cover, but under 2 years we don't. So those are the two things that we don't cover: fraud and suicide under 2 years. But other than that, we have to pay because the policy has been underwritten before we issued it.
So to summarize this point on underwriting, if you go through the bank and the lender, you're going to answer a couple of really quick questions at the time of your application. They're going to, unfortunately, falsely reassure you that you're covered properly for your mortgage, when technically speaking, they are covered properly for your mortgage.
It's in the contract.
It's in the contract, of course, but you leave there thinking, well, I have
who
life
reads
insurance.
The contract?
Exactly.
Let's be
who leaves
honest,
there?
Right?
Let's talk about real things here. And so anyway, back on my point here is with the bank, you're going to go get insurance. You're going to pay for it, and you pass away, let's say, and you have somebody that has to take on the mortgage. They're responsible for the mortgage, and then the bank can determine whether or not they'll pay. At that time, you don't even have the peace of mind while you're alive that you know it's going to pay, and you're paying for it for the bank anyways. You're paying for it knowing now, if you've watched this, that it might not even pay, and you have no control over that at all. Versus if you come over to a private institution, you let somebody that's licensed like ourselves take a look at it and try to provide you with a solution that is cheaper and obviously has all the benefits that we've already talked about. We determine that from the get-go whether or not it will pay, unless it falls under the fraud or suicide within 2-year clause. We are going to determine from the get-go if you are eligible for this to pay out, and you are going to have a definitive answer from the get-go. Is this going to pay or not? Because we've done the due diligence, we've done the medical questioning, we've looked into your medical files to the degree where they've made a decision and they can guarantee or not whether it'll pay out within the term of your policy.
Exactly.
So,
and talking about the costs, you mentioned the costs. So, why is it that we are cheaper than a lending company? 9 times out of 10, we're going to be less expensive than the bank.
At the same price or less, for sure.
Exactly. And part of the reason why is because we're in an insurance company and banks are not an insurance company. And when you look into your policy, you'll see that it's not the bank that holds the contract. They contract that out to a third party, and most of the times are company that like us, or other companies, another provider in Canada with big companies. So the bank does not hold the contract. And when you call the bank to talk about your mortgage insurance, they'll say, call the insurance company. And then you get confused. You're like, well, no, I got it through you. And it's like, I understand, but
you're paying us, but we're not going to serve you.
Exactly. So a bank or lender insurance can be less flexible in terms of pricing and is often based on a group insurance rate provided by the lender. Premiums may stay the same, but coverage decreases as the mortgage balance decreases. So part of the reason why it's a higher is because they treat it as group insurance plan. So if they have a higher clientele in age, that's going to affect. If there's more claims, that's going to affect the premium.
So you're telling me if I'm with XYZ Bank and this year at XYZ Bank, out of some fluke, a lot more people passed away who had mortgages with XYZ Bank, and a lot more people had to have their mortgages paid off by the bank, I'm going to pay more because of that?
Not saying that, but there's a possibility as it's treated as a group insurance plan.
And that's how group insurance is treated.
And that's how group insurance plan is treated. Okay.
Gee whiz.
As a financial security advisor, we can often customize the coverage to suit your needs. Example is a term life or a permanent life insurance, and the premium generally remains level and the coverage amount stays the same throughout the terms. We can't change it.
Right.
You subscribe to it. That's the price for 20 years, for 25 years. It doesn't decrease while you're paying off your mortgage. It stays leveled, and so is the price. And the last point I want to bring is the beneficiary. If you go through a lending company such as a bank, the bank or the lender is the beneficiary, and the funds goes directly to paying off the mortgage. And with somebody like us, is you choose the beneficiary, example, your family, and they decide how to use the death benefits, offering more control and flexibility for your loved ones. So that's a big point too, because now they can disperse the money how they want. They can pay off the remainder of the mortgage, and they have more money to play with at the end of the day. Not only it can be less expensive, but they have that flexibility and they control how they want to do the payout. Let's say they don't want to pay off the mortgage because the spouse is like, hey, I can sustain the mortgage myself. There's not much years left on it. I'm going to keep the money for myself and pay off other debts or other things, pay for the funeral expenses, and they keep on the mortgage and they don't need to pay it off. So that's a great flexibility to have on the client's end.
And just to recap this for a more direct example for listeners, I mean, I'm just going to say this way. I'm going to say it as it is. If I pay for something, if I am paying for something, I would like to have the control over what happens with it. I would like to dictate that. If you're paying for something, wouldn't you want to dictate what happens with it, especially when it involves finances, and especially when it involves finances at this level for your family? I mean, I think it's a no-brainer. I don't think anybody's going to say no to that. I know for myself, I can only speak for myself, of course. I can't speak for anyone else, but I think it's very important. So what you just talked about there, Phil, with the beneficiary, I think is really important for people to realize you're paying for this. This is a service that is being paid for by you. You should have as much control as possible over it. And with the bank, you are getting the least control possible out of it. The very least. It's the worst way of doing it. We do it the best way, and I would like to reaffirm that it's an absolute no-brainer. there's so many positives that outweigh everything else across the board on this topic. So we thought it was very important to do an episode on this, but I really wanted to refer that.
Not just the pricing point, just how the underwriting is conducted.
Correct.
Right. How the payouts is being controlled by the beneficiary as well. Where the payout is being and who receives the money too, right? So it's not just the price. Like for me, like if I would be paying the same amount, well, of course, there's going to be one that will outweigh the other just because of the flexibility, the underwriting, the reassurance that I know we're going to get paid. It's not like, oh, I did not know that maybe they won't pay. How come they didn't tell me? Or, well, of course they're not going to tell you, but if you read your contract,
that's what it says.
It's going to be in your contract. So that's what the importance is to read the contract. I mean, we talk about this to our clients because it's the importance of it to make sure they're covered. You know, they have their contract, they can read it, but we can go through that with them. But it's just to outweigh those the pros and cons.
And again, if you don't want to read your contract, so be it. That's fine. Take 30 minutes out of your day and come talk to us. Come talk to somebody like us. We'll be very happy to read through it for you and explain to you how that works. It's all part of what we do. And you know, it's if I can do, you know, as many people as possible to get them in the right coverage for their mortgage insurance, I sleep well at night knowing that. So I really wanted to make sure that we have an episode about this. Phil, thank you so much for covering all of these topics and having this discussion with me. Any questions about this can be easily asked in the comments section below. We can, you know, obviously open up some Q&As and we have our social medias linked in the description as well, where you can interact with us and ask us more questions about this. But if you are a homeowner currently, or if you're planning to be a homeowner, I can't express how important this episode is.
Yeah. So what they should do? What they should do? You're a homeowner. What they should do?
What should you do? What should you do? You should contact us. You should get in touch with us so we can sit down with you and we can take a look at this. This is something that can be fixed in about 15 minutes. I wish I was kidding. I wish I was exaggerating when I say this can be fixed in about 15 minutes. We can
contact your financial advisor, call us,
and you know, and it's a very easy thing to do. It's not a complicated process on our end, and it certainly is not for you. So you know, I think the easiest way to do that is for the cost of 15 to 30 minutes. Let's say 15 and 30 minutes of your life to just sit down with somebody like us who's licensed to do this and take a good look at this and make sure you're doing the right thing. With your money, you're paying for this. Let's make sure you're doing the right thing for it.
Now it's 5 minutes to get a quote and eligibility to see if you even qualify, and 10 minutes for the paperwork signature, and
we're done.
That's it. So it's a very, very quick process.
Absolutely. So wanted to say thank you very much, Phil, for covering this topic so well and accompanying me here today, and thank you for the to the listeners for watching and tuning in. I know that we have a couple of channels now where we're on Spotify as well. So if you want to hear us in your car, if you want to hear us while you're taking your jog or your walk, you can take a look at us there. If you want to watch the podcast visually, obviously we're on YouTube. My name was Shane, joined here by my co-host as usual, Phil, and we are the HarbourTrust Financial Podcast. Can't wait to see you next week.
Bye-bye, everybody.